I don't mean to be dramatic, but if you're a new student to risk measurement, and especially if you're a Part 1 FRM candidate, my video today is especially important simply because it describes a foundational idea that is applicable across asset classes, and that is I would like to illustrate exactly what we mean by the delta normal approach to value at risk. And that delta normal approach is the most commonly used approach within the broader classes of parametric approaches to value at risk, which we could also call analytical approach. It is the most common, however, it is by no means the only approach to a parametric value at risk. And I'd like to illustrate it with the two most popular use cases, the delta normal in the case of a long call option and in the case of a long bond position. And I'll show that they follow exactly the same template, which is that we're measuring our value at risk or our worst expected loss as a function of a sensitivity to a risk factor. Sensitivity multiplied by risk factor. My previous video in this playlist that introduced the parametric approach to value at risk focused on the estimation of the most popular parameter here, which is volatility, and I've denoted this, as usual, with Greek sigma. I emphasize that word estimation of volatility because you may recall volatility does not exist in the moment. We estimate it, either probably with a historical series, but we could infer that estimate by way of implied volatility. But it's either estimated or inferred. It is not instantaneously observed. That volatility as a parameter typically goes into the delta normal approach, which I'm going to explain here with two of the most common use cases. But notice how I have drawn this out to explicitly identify that the delta normal approach, which is the most common, is an example of a parametric approach. What I mean there is that there are many other types of parametric approaches. So parametric is also safely called analytical, so that we can distinguish here between analytical or parametric approaches to VaR as opposed to simulation-based approaches to VaR, of which there are primarily two, or three big buckets. Delta normal is so common that it is oftentimes confused for the analytical or parametric approach to VaR. However, it's not. There are many other types of approaches. And at the end, we'll come back, and hopefully after showing you the two common use cases, I'll be able to successfully explain to you exactly why this is called the delta normal approach. And we get this question a lot, especially by Part 1 FRM candidates, and I always consider it a good question because I don't think it's obvious just by looking at the label what exactly is meant by delta normal. I will also say that there is a synonym here by my favorite author, Carol Alexander, prefers to call this normal linear VaR, and I agree with her as usual. I think this is a better technical term to describe the delta normal. I'm not showing it simply because it's just less common. We see delta normal a lot. And in the delta normal, we're going to see it's very simple. It's the sensitivity to a risk factor, or sensitivity multiplied by risk factor. I'm going to show you a stock option where we have sensitivity here in red multiplied by the risk factor, which is the worst expected change in the stock multiplied by sensitivity to it, which is delta. And in the case of a bond, the risk factor is worst expected change in the yield, and then sensitivity to that is duration. If you want an analog here for that simple concept of multiplying the sensitivity and the risk factor, there's the capital asset pricing model, which can in fact be used for this delta normal approach. And you may recall that in the CAPM, its expected excess return is simply equal to, and that's in excess return in excess of the risk-free rate, is equal to the product of two variables, right? It's a sensitivity, beta, to the common risk factor, which is the market premium or excess return on the market portfolio, which I'll denote ERP, could be MRP as well, right? That's the CAPM sensitivity to the risk factor. That's how the delta normal approach works. And it's pretty useful across various asset classes or position types, right? So we can have a portfolio where the risk factor we probably would map the portfolio to primitives, perhaps index returns, and then sensitivities, which would be betas, to those risk factors. In the case of a futures contract, it could be a commodity return, and our sensitivity in the futures contract is pretty close to 1, just like in the forward contract. In other words, when the underlying commodity price moves, we're pretty much 1 for 1 on the futures or forward contract. So then the two cases I'm going to show you, use cases, are the option and the bond. In the case of the option, we can map to several risk factors, including volatility, including gamma if we wanted to. But the first and most important is simply a change in the stock price. If we're long a call option, our exposure is first of all to a drop in the stock price. So our risk factor here is an adverse change in the stock price, and then our sensitivity is delta. So that our value at risk is going to be a worst expected change in the risk factor multiplied by the delta. In the case of the bond, the risk factor is going to be an adverse change in the yield, right? If we're long the bond, that's a yield increase. So it's worst expected shock or adverse change to the yield multiplied by our measure of sensitivity, in this case, duration, specifically modified duration. Okay, so if I look at the option first, I've made some assumptions here that we are long a call option that is at the money when the stock price is 100. And I've plotted that option price here. Here's the red dot. When the option is at the money, the stock and the strike are 100, and my option price is equal to $13.75. If I assume a 1-year option and a volatility of 30%. So those choices are arbitrary. And then I've got a daily volatility you can see here. I just took that 30% and scaled it per the square root rule, assuming 250 trading days in a year. So I have a daily volatility of the stock price. In percentage, that's 1.9%, or in dollar terms, that's $1.90. And so then here I am stressing the risk factor. So now we see why there's a normal in the delta normal, because we're assuming in this case that the stock price has a normal distribution. We, as usual with the value at risk, need to select a confidence level. Two common choices are 95 and 99%. I'm going to use 95%. And so 1.64, right, per the built-in Excel function is the quantile or normal deviate that's returned for us. In other words, for the standard normal density function, 95% of the area under the curve is to the left of the quantile 1.64. So then we get the VaR of the risk factor, which I've deliberately labeled there as VaR of the risk factor to highlight the fact that any variable can have a value at risk. This was recently discussed in the forum where one of our customers had an aha moment, right? And my point there was anytime we have a probability distribution, the VaR is just the worst expected change on one side of the distribution, the loss side. So we can talk about the VaR of any variable where there's a probability distribution. In this case, it's the VaR of the risk factor, or the worst expected change in the stock price, right? Given that volatility of assumption of 1.9%, if it is normally distributed, then the 95% VaR of the underlying risk factor is $3.12. This doesn't yet answer for us the question of what's the VaR of the option position, but it is a valid VaR of the risk factor. What we mean here is that conditional on this distributional assumption, 5% on 5% of days, we would expect the stock price to drop more than $3.12, right? So VaR of the risk factor. All I've got is the $1.90 multiplied by the 1.64 normal deviate. And so I think of that as a stressed or shocked change to the stock price, right? So that we go back to our basic template here. We're going to have a change in the stock price. That's our risk factor. And we're multiplying that by the sensitivity to that worst expected change in the risk factor. And that sensitivity is delta. And now what is the worst expected change in our risk factor? Well, in this case, it's going to be our stock price multiplied by our volatility. I'll put a multiplier there in, multiplied by the normal deviate associated with our selected confidence level, right? Z to indicate that we're talking about the standard normal distribution. In this case, a 95% confidence or 5% significance, right? So that describes the worst expected change in our stock price, a drop of $3.12, and that's going to be multiplied by our sensitivity to that change in the risk factor. We're holding the option. Lindalen also calls this, in general, the transmission parameter, right? It transmits the implication of the change in our risk factor to our position. And so this final step is very sensitive. I've got the sensitivity here is the Greek option delta, and I've rounded here. It's 0.6. This is an at-the-money call option, and so we know it's between 0 and 1, typically a little above 1/2, and I've rounded the actual just off to 0.6. So that's our familiar option Greek delta. And so we can see here that the position VaR, as advertised, is just the risk factor, the shock of the risk factor, or what I call the VaR of the risk factor, multiplied by the delta. $3.12 multiplied by 0.6 is $1.87. In other words, assuming this stock price is normally distributed with a standard deviation, a daily standard deviation of 1.9%, then because the worst expected loss on the stock price or drop in the stock price is $3.12, that implies via the delta transmission parameter that the worst expected loss with 95% confidence on our long call option is $1.87. Only on 5% of days do we expect to lose more than $1.87. I've also got in here, because I'm next going to show you bonds, and I want to show you this as a common template, we could have calculated the delta as a ratio, or strictly speaking in percentage terms. In this case, it would be 4.36. I'll leave that to the spreadsheet if you want to take a closer look there. But I'm not focusing on that because that would be a very unusual way to express delta. You never see that. We see the delta here as 0.6, and it's unitless quantity. And we could express the sensitivity ratio and then derive the position VaR in percentage terms. The difference there is merely units and convention. Greek option delta is unitless, and in a final twist of irony, it would strictly speaking be called the percentage delta. However, I'll continue with the template. Now, what I've just done here is added a column for a long bond position, and I have not changed the structure because I wanted to show that the bond also fits the same template. It's in fact a little simpler, right? Okay, having shown you that it fits the same template, I'll get rid of the option and then just focus here on the bond, and the plot here, probably familiar, of the bond, where I'm assuming we have a long position in a 30-year zero coupon bond where I've got plotted here at red is the price at a 5% yield, and it corresponds to $22.31. And that's because I've done this as simply as I can, which is assumed that the yield is with continuous compounding, right? So that turned out to be very elegant. That's a decimal. I can simply discount. I can simply take the face value of 100 and multiply by e raised to what I have in the exponent is negative the 5% yield multiplied by the 30-year maturity. That gets me the 2231, very elegant for a zero coupon bond with continuous compounding. And then I've just assumed I've made an assumption here, I could even put that in yellow just to highlight the assumption, that the daily standard deviation of the yield is 10 basis points. And okay, here you'll notice I've got the same normal VaR deviate of 1.645 because that's just a quantile for the standard normal distribution. So notice again, what I have in common is I'm assuming a normal distribution of my risk factor, but here my risk factor is the yield. So I'm assuming that if the daily volatility if the yield volatility is 10 basis points, then we could call the VaR the risk factor. We can call this the VaR the risk factor and say it's 16 basis points. In other words, only on 5% of the days would I expect the yield, the adverse change to the yield, to be worse than 16 basis points. In this case, with a long bond position, that means only at 5% of the days do I expect the yield shock to be greater than 16 basis points, because that's in the adverse direction. Okay, so my value at risk then becomes, again, in keeping with the template, right, we've said it's a risk factor, which is the change in yield, multiplied by the sensitivity. And what's my worst expected change in the yield? Well, we know that is now the standard deviation of the yield multiplied by, if we assume that it's normal, the standard normal deviate given some selected confidence level, in this case 95%, right? So that's my worst expected change to the yield, and we multiply that by the sensitivity or generically transmission parameter of modified duration, right? And in fact, that's all that we need to do here is take the 16 basis points, multiply it by the sensitivity modified duration, which is 30 years, right? That's because I selected a zero coupon bond and the yield is continuously compounded. So conveniently, this is the unique special case where my modified duration equals my maturity in that zero coupon bond when the yield is with continuous compounding. So the 16 basis points can be multiplied by 30, and I get the position VaR in percentage terms. In other words, the worst expected change to my bond price in percentage terms is 4.93%. Right, just going back to my basic formula here, where my worst expected change to the yield is, is sigma, standard deviation of the yield, times the normal deviate given some level of confidence, then gets multiplied by the duration. That gives me an estimated change in the bond price. So the other common way to use this then is to just multiply this by the price, and that will give me an estimate of the change in the price in dollar terms. Okay, so and just to summarize that, the position VaR here of 4.93% is because I have a long position in a 30-year zero coupon bond with a current price of 22.31%. And so with 95% confidence, I do not expect the price drop here to be worse than 4.93% because I have a modified duration of 30 multiplied by my worst expected change to the yield, which is 16 basis points. If the yield changes more than 16 basis points, which should only occur on 5% of the days, then my bond price can be expected to drop more than 4.93%. And now we can start to understand why Linda Allen would call this the normal linear VaR, because this is a linear approximation. Here in the bond versus yield plot, we hold the bond here at price of 22.31, and there is a tangent line here. If we think back about calculus, my lines should be straight. That's the tangent, and that its measure is actually the dollar duration. And what we're saying here is if the yield, what's the worst expected change, shock, adverse change to the yield, in this case that's an up yield move. And using this line, where would we end up? And so we'd end up here down 4.93% on the price. And so we're only using the line, that's the linear approximation associated with duration. That's also, so it's elegant, convenient, fast. It's also, its weaknesses, it's omitting the convexity here in the curve. Just like when we go back to the option, right? There's a tangent here. That slope is delta. And with the long call option, what we're estimating here is if the stock price drops, what's the worst expected change in the stock price? And what does that tell us about the change, the drop in value of our option? Just along this line, we're only using delta as the linear approximation. We're omitting the curvature. In that case, we're omitting the gamma. And so the gamma mathematically is essentially similar to the convexity in the bond. And so then finally, I did promise that we try and go back now and understand the delta normal. And the reason is that the delta here is acting as a synonym or proxy for any of the sensitivity measures, right? In the case of the option, this delta is accurate, but if it were a bond, its duration. If it were an equity, it would be beta, right? So here we have the sensitivity measure is the meaning of delta, and then the normal is what we're assuming is the distribution of the risk factor, right? Sensitivity, and then assumption about the risk factor. And then you could see why, as I've mentioned now, Linda Allen would prefer to call this the linear normal because we have just a single factor sensitivity that gives rise to this linear approximation. And then in the same way, we're assuming that the risk factor is normally distributed. So I hope that finally put some understanding as to around why we would call this the delta normal approach to value at risk, but also why it's just one type, specific sub-approach within the parametric or analytical approaches. Because for one thing, we do not need to assume that this risk factor is normally distributed. We can assume it has a student's t-distribution or something else with a heavier tail. So I hope that's a helpful overview to a critical concept, a template in risk measurement. If it is helpful, please subscribe to the channel and stay current with the videos as I publish them. Thank you.